My name is Joe Hadzima. I'm a senior lecturer at the MIT Sloan School of Management, and this presentation is about using stock and options as compensation for services. The topics today, we'll start off talking about the capital structure stack, that is, what are the various instruments that have claims on the assets of the company, so that we have a better idea of where the instruments we use to provide compensation for employees and service providers fit in. And then we'll talk about founder stock and some of the issues there that typically trip up founders or could trip up founders. Then we'll talk about the various vehicles or ways in which you can provide equity as compensation, some of the pluses and minuses, and then we'll talk a little bit about the regulatory considerations for that. So the capital structure stack, as we call it, if you think of a collection of people that have rights to claim on the assets of the company as a stack, where the person at the top of the stack gets first cracks at assets, then we start with secured debt at the top. This is debt, typically loans, advanced to the company, secured by assets of the company. For example, a mortgage on a property or some equipment. The secured party has the right, in the event of default, to go and seize the asset and try to liquidate it. And to the extent that that covers the debt, they're good. To the extent there's stuff left over after expenses, that's available to others. And to the extent the debt is not covered by the assets have gone down in value, let's say, then the part that is not paid off, that claim becomes the next part of the stack, which is unsecured debt. Now, unsecured debt is any other debt of the company that is not secured by any assets. This would be trade credit when you buy something. These would be perhaps the landlord for leases, to the extent they haven't taken a security interest. Anybody who's advanced credit or to which the company has an obligation comes in this unsecured debt to the extent not secured. Below that is what's called subordinated debt. Now, subordinated debt is debt which by contract has agreed with all the other creditors that it will be paid off after all the other creditors. This became popular during the LBO buyout rater history, where it was figured out that subordinated debt had superior returns to normal debt, something that sometimes traded close to what you'd get if you owned stock in the company. So these three parts of the stack are the debt, and they get first dibs on the assets of the company in the event of it goes underwater or etc. Now, below that is equity. This is people who have ownership in the actual assets of the company, not claims, but actual ownership based on the instruments. And the top of the stack is preferred stock. Again, this is stock that comes ahead of other stock, typically used in things like venture capital investments. For more on that, you should see my video on investing in new ventures to talk about how that all works. And at the very bottom is common stock. This is the residual value of the company after everyone else is paid off. For a startup, this is very, very low value. For Microsoft, it's a big value. So this is what, again, is left over after everyone else gets their crack at it. Now, just to review, debt is for borrowed money or obligations that you incur. This could come, for example, from settlement of a law or an adverse claim in a lawsuit, which you lose for somebody slipping and falling, etc. But it's basically for a fixed amount with interest and little little or no upside. You could think of interest as, what you're paying to rent the money from the debt holder. Stock, as I said, is rights to the ownership of assets of the company through the stock. Preferred stock being at the top of the stack. You should see venture capital deal terms in the nuts and bolts of New Venture course materials for more information and detail, or look at the investing in new ventures for the details of preferred stock. Typically given to venture capitalists and investors, liquidation preference in the event the company is liquidated, often convertible into common stock for upside. It has typically anti-dilution formulas, which adjust the amount of stock that you would get on conversion, based on future rounds of financing, often with board representation and veto or approval rights over certain types of things. Common stock, that residual value stock at the bottom of the pyramid, is usually given to founders, employees, or other service providers. Has no liquidation preference or convertibility, because it is it. It is it. It's the residual value after others gets theirs. Now, there can be different classes of common stock, as there may be with our preferred stock. In common, there could be voting or non-voting and different voting rights. For example, with the unicorns going public with founder-led companies, there has been a trend where the founders have a class of stock to give them super voting rights, 10 or 100 votes per share versus the normal stock. Historically, that's not been acceptable to Wall Street, but in times when people see the upside is so big, this has been able to be negotiated. It gives the person holding those shares an outsized influence on what happens to the company. And finally, warrants or options, or the rights to buy shares or other securities at set times for stipulated prices. And we'll talk a little bit about options in the employment context. Warrants are similar, usually talked about, not involving compensation, but other ways in which people might get an interest in the company. For example, I've seen some vendors, major partner ventures, being awarded warrants to tie them more closely to the company. Now, the question is, after we have the stack, but what counts in the stack? If we look at common stock, for example, these are some terms you should be familiar with. First of all, there's authorized number of shares of common or preferred. These are set forth in the charter that's on file with the Secretary of State in the office of the state in which the company is incorporated. There are issued shares. These are shares that the board typically has said we want to issue to somebody. And then there are treasury shares. Those are shares that have been issued that have been repurchased by the company. And what's left after all of that is the issued and outstanding. So in this example, authorized 300,000 shares, 150 were issued, 150,000 issued, 25,000 repurchased, issued and outstanding 125,000. Authorized, not issued, is 150,000. And typically, they would be reserved for things like option plans or perhaps for conversion of a preferred stock. And what's left after all of that is called authorized, not issued, or reserved. If you need to increase the number of shares, the number of authorized shares, this would require amending the charter, which would require shareholder votes. So what counts? Let's say the company is sold for $150 million and you own one share of stock. How much do you get? Well, it's based on the number of issued and outstanding shares. This is assuming that the options have not been converted. So it's either, if there are no options converted, you get $1,200 per share. It's 150 million divided by 125,000 issued and outstanding shares. And if the options have been converted, exercised, as we call it, it would be 150 million divided by 175,000 shares, or $8.57 a share. So understanding, what counts is an important concept you should have. Now, as we move into the area of compensation and equity, you have to ask whether providing equity to employees and others, does it really motivate? Equity can be a confusing subject, and people don't quite understand it without some education. And you have to ask, are you working for wallpaper? The first company I worked for out of college, I was a number 3 employee. We were in a big townhouse in Cambridge, and the new company was up on the top floor. And as these old houses have, they have little half baths under the first floor stairs going up. So first day at work, eventually coffee, had to go down to use the bathroom, opened the door, and I observed that the walls of this little half bath were papered entirely in real stock certificates, which was quite a sort of a shocking type thing. It sort of says to me, unless you want to be working for wallpaper, maybe you should get back to work. The point is, you don't know what your stock is going to be until there's an event where you cash out. And so you have to ask, do employees really understand how equity works? So for example, if you were an potential employee of company A or company B, and they're similar companies, let's say, and company A offers you $100,000 and 5,000 shares, and company B offers you 100,000 cash and 10,000 shares. Which one is better financially? Well, you have to ask how many shares. What do the shares that you're being offered mean as a percentage of the company? So you can see these are essentially the same offer, which is an important tip when you're hiring, especially entrepreneurs early on. You shouldn't talk to potential employees in terms of percentage of the company, where you say, I'm going to give you 2% or something. And the reason is the percentage is going to decrease over time. So let's say at the beginning, we have founders with 90% of the company and employees 10%. Now, if you offer the employees 10% of the company, what happens when investors come in? Well, the natural process of issuing shares are going to decrease the percentage everybody owns. That's called numerical dilution. Hopefully it increases the economic value, because 60% instead of 90% is going to be 60% of something that has money and assets and other things. But if employees think they're entitled to 10% and you come back and say, well, now you have 7%, you might, and there have been cases on this where people have claimed they were misled on it. So don't talk in terms of percentage of the company. Instead, you can talk about percentage, but make sure you say subject to dilution with everybody as investors come in, etc. Okay. Now, what about founder stock? This is holy grail. I'm a founder of a company, I get stock, and the question is how much? Well, the split of equity among founders could be the subject of hours of discussion, and there are many different views on it. Part of equity splits and founders is the culture you're trying to establish. So some people would say we want everyone to have ownership interest in the company. That's a culture issue. An example on the other side is Keenan Systems. Keenan Systems did software, billing software for the telecommunication companies. And Keenan, the founder, Keenan Sahin, owned 100% of the company when it was acquired for $1 billion. He ended up giving $100 million to MIT. He had been an MIT professor. Now, how did that work? Well, the culture of that company was people were paid very well in cash, and it was understood that he, was going to own the company. That doesn't work all the time. It's really, the point is, what kind of culture do you want to do? Who gets what, and how does that work? In thinking about how founders split, though, you want to talk about, what is the value of past contributions? What's the value of future contributions? Over what period of time? Who's giving up what and who's committing? Is there ownership of intellectual property involved that somebody should get more value for? What could the person earn externally? And there's a concept of internal equity. You should assume that everyone is eventually going to find out who owns what percentage. Using these kind of approaches, there was a startup that I was counseling where there was a postdoc and a professor, and they were starting a company based on technology that both of them had worked on. And the question is, how did they split the equity? And what I suggested is that each of them go and write down, what they thought they were giving up if they worked on the company, how much time they would spend, what they could be making outside, what other opportunities would they miss, etc. So for the professor at MIT, professors get 1 day a week for consulting, and so there's a value to that the professor gave up. On the other hand, the professor's not working full time, continues his work. The postdocs essentially said, well, I'm giving up the potential for an academic career. I can get this salary. If I go and work for these kind of companies, I'm going to be working a lot of time. And so they put these down and they sort of talked it through. And they both understood that they were going to give ownership interest to the new entity. But talking it through made sure that both of them understood the perceptions of the other. And it actually worked out quite well for everybody. Now, there is a little catch with founder stock, actually any stock, but it hits founders perhaps more often, and it's called Section 83 of the Internal Revenue Code. And here's what it is. Whoops. If you receive property in connection with providing services, you have ordinary income. This is federal, tax up to 35% or whatever the rate is at the time. That's equal to the fair market value of the property you obtained minus what you paid. An example, and in this case, stock is property in a company, a corporation. Ownership interests in LLCs, I think, have not been deemed to be property for this, but you should check that. If you don't rely on this, the rules change. But let's give an example. So suppose Michael and brother-in-law are talking, and Michael's the entrepreneur, and Michael talks to brother-in-law about investing in the company. Brother-in-law says, I'll give you $1 million for 50% of the company. Well, let's set it up and let's get going. And so the question is, does Michael have any income? Well, he received 50% of the company. The company maybe has $1 million in it, so you could say maybe it's $500,000. He hasn't paid anything. He's got ordinary income of $500,000 and tax at say 40%, $200,000 in cash he has to come up with to pay the tax. Now you could argue, wait a second, if brother-in-law pays $1 million for half the company, isn't the other half of the company worth $1 million? Well, yeah, it could be, probably is. And so it could be up to $400,000 in cash needed to pay taxes. And you'd say, wow, this is crazy. How could this be? Well, the problem is it gets even worse. And I'll talk about how you can avoid it. But the problem even gets worse because typically stock is vested over time, meaning if you don't continue to work for the company, you will lose some of that stock. And the reason it's vested is Michael, brother-in-law, says, look, when I write my check for $1 million, I've basically done everything, and you haven't done anything, Michael. So if you don't keep rowing the boat, so to speak, over the vesting period, I want some of that stock back, so I can go out and find somebody else to carry on. So if the stock is vested over time, and you have a right, you may end up losing it. This is called a risk of forfeiture. And under Section 83, you measure the amount of income you get if there's a risk of forfeiture when the shares vest. So think about this situation where the shares are maybe worth a penny at time 0, and you work hard, and something comes along that values the shares at 100,000, and you happen to vest that. Let's say an outside investor comes along. Well, now the amount of income is based on not a penny a share, but $100 a share times the number of shares you have. So it's a huge problem. Some cases a number of years ago in which a CFO came on board a company after it had received several rounds of venture financing and was awarded some shares. He went and filed what's called an 83B election. An 83B election says, look, I know my shares are subject to vesting. I want to have the income measured now instead of waiting until it vests, and I'll pay my tax now. And this has to be filed within 30 days of the time you get your shares, which leads to a typical problem for founders. But let me come back to that in a moment. Anyway, this CFO comes along, being the first CFO of the company after several rounds of venture, and says, here's my 83B election. You have to file it with the company and file it with the IRS. And the controller said, well, what's an 83B election? And it turned out that a whole bunch of stock had been given out to a whole bunch of employees, all subject to vesting, and no 83B election. And so it had a huge built-in tax liability. Lawsuits were filed, and both the accounting and law firms had to pony up money for not, pointing this out. So anyway, don't get in that situation. So how do you avoid the 83B trap? The problem comes if you are forming the company and issuing stock at a time close to when there's a valuation event that's hard to ignore. So for example, I've seen many cases where somebody will come in and say, hey, I just got a term sheet. We got to set up a company, and we're going to close next week. And you go, well, wait a second. You're going to get shares, and we're setting the company up, and the money's coming in. It's going to value it. Whoops, problem. What made the company go from no value today to the value this term sheet says? And unless there's something like a patent is issued or FDA approval or something, it's hard to make that case. So the point is, you should set the company up, corporation up if you're going to have a corporation, issue the stock, and then go ahead, file the 83B election if you're going to put some vesting on it. Whole question of whether founders should self-vest their stock, and I would argue that that's a good idea because outside investors are going to want you to do it, so you might as well do it on your terms, at least think about it. So anyway, issue the stock, file the 83B election, go out and start to raise money. It's going to take 6 months or more anyway, and separate in time when you get the stock and when the investment comes in and sets a higher price. And so if 6 months, you can argue lots happened, and I filed the 83B election. So why is this a problem? Why doesn't stock get issued in time? And why do people wait? Well, sometimes people are too busy, not sure who should get what, because we're still trying to figure out, who's making what contribution. I think there's a particular problem in the case of technology startups that I've seen at MIT. And that is, if you look at the relative importance of the technical person versus the business person over time, I would say that early on in the company, the the technical person's relative importance is high, and the business person is lower. The magnitude here doesn't matter, it's the relative position. And think about it, the technical person is working 80 hours a week trying to get the thing to work, and the business person may not have left the day job, is working weekends. There's not a lot to do other than strategic planning and but thinking about markets, and not saying there's nothing to do, but relative to the amount of work the technical person's putting in, it's nothing. The technical person may also have the intellectual property, so it's my property, I'm working my butt off, and we're talking about splitting stock. I should get most of it. Well, for a successful company, what's going to happen is it requires both of these. So over time, the technical person's relative importance is going to go down as the technology is proven out, and the business person is going up. So recognizing that a win-win situation is a good technology with a good plan and execution behind it makes for success. We ought to be thinking down the road a little bit about who gets what in the company, and have that discussion up front. You can always moderate it by having vesting. So if the technical person decides, I'm not going to spend this much time, I'm going to go do something else, loses the stock. If the business person goes and says, I'm going to go take a high-paying job with a high-flying public company, they lose the stock. But understanding this dynamic helps that discussion. Other approaches to avoiding Section 83 or reducing its impact. One would be, in our case of Michael and brother-in-law, is to issue what's called participating preferred stock to brother-in-law and common stock to Michael. Now, participating preferred, there's a whole discussion of that in my video on investing in new ventures. But essentially it says, in the event that the company is liquidated, or there is, and liquidation could mean purchase of asset acquisition by a company in a positive sense, as opposed to just necessarily it's going out of business. In any event, the participating preferred, Michael would get the first $1 million off the top, and then would have a right to convert into common. So he would then get 50% of the common. And so that's a participating preferred. And why would that potentially help out here? Well, the question is, what is the value of Michael's common when the only asset in the company is the $100 million that the brother-in-law has put in with this instrument? Well, Michael's common really is an option on the future value of the company to the extent that value is greater than $1 million. And question for all you finance people out there, what would you pay for an option, such an option, with an unlimited duration and an unlimited upside? Sort of 5 to 10% is sort of rules of thumb that have been adopted when it comes to pricing options, stock options and common stock, when there's venture capital first round investing. Now, in doing this, you have to think about subchapter S implications of preferred stock. Subchapter S, as you will find out in the Forms of Doing Business video, is a corporation that does not pay tax at the corporate level, but passes through any tax attributes of profit or loss to its shareholders. And if it meets the requirements of being subchapter S, and one of the requirements is that there can be only one class of stock. So if you give Michael common and brother-in-law preferred, you would no longer be able to be a sub S. So you just have to think about it. You can avoid, again, all of this by incorporating getting the stock out, filing the 83B elections that if you have vesting, and separate in time that activity from your successful fundraise. Now, all this is sort of some basic stuff. There is some interesting things if you have some time. Mike Moyer has an interesting concept about slicing the pie as a way of figuring out who gets what among founders. It looks at the share of the reward versus the share of what's actually done and at risk. I've never seen been personally involved in any situation that's used this, but it's an intriguing concept to think about, and perhaps provides a method for discussing who's going to actually do what among founders in the company. Okay, so we've talked about founder stock, but let's talk about providing equity, if that's what your culture you're trying to do, for people that come to work with you, either employees or consultants, board members, etc. And you have to remember there's an external market for talent, and if you're in an industry where programmers get offered equity all the time, you pretty much probably are going to have to think about that. So you have to think about your competitiveness in the external market for talent. But having said that, what can you offer? What are the instruments? Well, there are three common forms. One is restricted stock. Another is incentive stock options, which have certain tax benefits. And then non-qualified stock options, which are options that don't have those tax benefits. So let's dig into those. Restricted stock is stock that's sold or granted outright to a person. In this case, let's say your first outside employee. It's usually done when the value of the stock is low, because if you remember the discussion we just had about Section 83, the stock, if it is actual stock given to an employee for service or somebody for services, that's going to be ordinary income. So if the value of the stock is too high, then you're talking about cash payments for tax. It starts the capital gains holding period because you actually have the stock. It also starts the holding periods for securities law purposes, for exemptions from registration. So those are good things. It's called restricted because it's subject to vesting and buyback by the company. By buyback, I mean it could be that the 100 shares are granted. We'll talk about what vesting conditions are, but let's say if you leave the company, the question is, can the company buy back the unvested part, or can they buy it all back and at what price? But typically it's restricted because it has vesting requirements to keep people motivated working for the company. So again, if 83B election is made, modest or low income at grant, no further income until the stock is sold, and then it's capital gains. You own the stock. The vesting, if you file the 83B, it's like you own it fully. For tax purposes, you don't get a deduction or anything at the employer level for any increase in value. Let me go back. So when you do sell stock, restricted stock, the holding period, if it's long enough, you'll get long-term or short-term capital gains, which means whatever you declared its value for 83B purposes is subtracted from whatever you get when you sell the stock, and the difference is the capital gains that you have to put on your income tax return and pay taxes on. Now, whether you can actually sell or not, that's a whole discussion around securities laws, which is beyond this presentation, but there are restrictions on sale. Okay, so what about incentive stock options, the next thing on our menu? Well, what are they? They're options, meaning rights to acquire stock in the company. They comply with certain tax requirements, one of which is there has to be issued under a plan that's approved by shareholders. Incentive stock options can only be granted to employees of the company. So if you're outside consultant or a board member, non-employee, you don't qualify for incentive stock options, called ISOs. The exercise price of the options, that is the price that you would have to pay in order to get the shares, has to equal at least the fair market value of the stock on the date of the grant. So if the stock's worth $1, then your exercise price is $1. If it is less than $1, it won't qualify as an incentive stock option. Typically, the right to exercise is vested over time. So again, the purpose is to keep people working, employees working for the company and motivated. There's no, unlike a restricted stock, there's no tax on the granting or the vesting of an incentive stock option. Those are not taxable events. There is the potential for a alternative minimum tax when the option is exercised. If it's essentially if it is the value on the exercise is large enough, it may be part of the alternative minimum tax calculations, which may lead to the requirement to pay taxes. And if you don't have cash, you end up having to sell the stock, in which case you're going to not qualify for ISO treatment. The ISO treatment itself is that other than the alternative minimum tax possibility on exercise, there's no tax on the exercise of the option. That's not a taxable event, so you actually have the shares. If you hold the stock before you sell it, if you hold it for at least 1 year from the date you exercised, and that date you sell it is at least 2 years from the date of grant, then you don't have any ordinary income, you just have capital gains, which is traditionally capital gains have been less than ordinary income tax rates. So that's a plus. The employer doesn't get any deduction for it. Think about it, if an employer paid you $100 in cash, you have to recognize the cash as income, but that's an expense for tax purposes that the employer gets. In the case of an ISO, where it ends up being a capital gains, there's no tax deduction for the employer. So that's a trade-off. Now, the final typical compensation for services is called non-qualified stock options, or NSOs. Now, these are basically can be given to anyone, vendors, board members, consultants, even employees, although typically you want to do ISOs with employees. There's pretty much complete tax freedom in designing. There may be some accounting issues if you have if the exercise price, otherwise sometimes called the strike price, is below fair market value. There might be some issues with that. There are some accounting issues about how you account for these that you'd want to look at, but you do have pretty much complete freedom. There's no tax on the grant of a non-qualified stock option or on the vesting. There is, however, an ordinary income when the person exercises the option, at which point the employer gets a deduction. There are some Internal Revenue Code Section 409A considerations. We'll chat about that a little bit later in this presentation. So non-qualified options are fine as long as you think about all of this stuff. If you have taxable events because you have acquired stock or you exercise in either a restricted stock or an exercise in a company where the stock is not liquid, you can't sell it, then you're getting taxed for getting a piece of paper. And most other places in the tax code, you only get taxed when you have cash. So if you go to work for a company and your salary, you get $1,000 in salary, you get your check, and they've taken out the taxes. And you grumble a bit because you don't have $1,000, you have less than 1,000, but you're only taxed because you got cash. And in the case of stock, you're getting potentially taxed just because you have a piece of paper. So it's a little bit weird. If you hold stock options, like a non-qualified options, you probably would not exercise, in most cases, those options until either there was a liquidation event, like the company is being sold, so you exercise the options, and you sell the stock in the acquisition, so you get cash, or maybe the company goes public and you're able to sell after that, or if the option expires, because typically these options have, certainly under incentive stock options, they can't have a life of more than 10 years unless you're one of the founders or high percentage owners, in which case it's a shorter period. Or even non-qual options are usually 10 years. So if there's value in the stock, it's not public yet, value because the last round of financing showed it had a lot of value, and you're at risk of losing the right to get the stock, you may have to exercise gulp and pay the taxes on it. And I've been in that situation once. It's sort of a good situation in the sense that, hey, there's real value here, but then you got to come up with cash somehow to pay the taxes. So there are other aspects to these various things and how they work from an accounting and logistics viewpoint, whether you can do things like pay the exercise price by surrendering some of the shares, net exercise it's called. Really interesting things well beyond this basic presentation, but just be aware that there are some nuances. But now at least you know what the instruments are, and as you think about which ones you're going to use and under what situation, you're better equipped to talk to your advisors about it. So we did talk on all these about vesting in terms of the restricted stock or vesting of the exercise rights. So what is vesting? Well, there are conditions on keeping what seems to have been awarded to you. And it's really to make sure that the company gets, for giving you stock, gets what it's hoping to get from you, which is your undivided attention working to advance the value of the company. Typically, these are time-based vesting. I mean, ideally, you'd want it performance-based, right? So, I give you stock, you're a developer, and what I really want is the product out the door. So if I structured it to say, when we get first product shipped, you vest in some percentage, that would certainly align what the company's hoping you'll do with what you actually are going to do. The problem with that is, you may pivot with, the product may change, there may be other things that happen. And so it's tricky to do performance vesting. Therefore, people fall back on time-based vesting, which says, look, we're starting on this journey together. We think we're going here. We may end up someplace else, but we're all rowing together. And so we're gonna, if you continue to be part of the team rowing with us, you will vest over time. Typical vesting that I've seen is 4 years with a 1-year cliff, meaning after 1 year, after you get the stock or the option, you're vested in 25%. And thereafter, most typically quarterly or monthly vesting. So for every month over the next 3 years or every quarter over the next 3 years, you'll vest, so that at the end of 4 years, if you're still there working, you're 100% vested. Now, there is sort of a debate about whether you should accelerate vesting on a change in control or an initial public offering. Now, change in control in this case is really a way of talking about an acquisition, hopefully a positive return acquisition. And an initial public offering is also viewed as sort of a success. So, hey, if we've all been working hard and we've got the company to a point it's being acquired by somebody else, it's a win. Or we're going public, that's a win. Haven't we accomplished what we were trying to do, and shouldn't we, everyone get vested fully? And there's some argument behind that. In the case of acquisition, the acquirer is going to want to keep some of the team anyway, often the technical part, not the business people or the accounting people. And so they're going to have to put more incentive in front of the people to continue on after the acquisition. So in a sense, the recognizing that the acquirer may say, well, I normally would give you X dollars, but I'm going to give you X minus Y percent because I got to make up for that incentive. And so some people say that's really taking money away from existing shareholders. The other argument is, well, these people have rode the boat successfully, so they ought to get it. It's a debate that goes on, but you should think about, who wins and who loses in this success story as to whether you want to do acceleration or not. So those have been their basic, vehicles for equity compensation. Now, a few regulatory considerations. Two things and a third category. Internal Revenue Code 409A, securities laws, and then filings. So 409A is a part of the Internal Revenue Code that applies to deferred compensation plans, employment agreements, severance agreements, other kinds of things that result in deferred compensation. And this would include a whole variety of things other than incentive stock options and restricted stock plans. 409 kicks in if you're not careful. It can end up with a 20% additional tax owed by you, the recipient. The company has issues, there's interest. Complying with 409A means you have to follow various restrictions and processes. You can it's all aimed at trying to figure out, has the stock been properly valued? And one way around that is to actually get the stock valued, independent valuation of the stock when you're granting options. Does provide protections if it's truly an independent firm. And you would have to do this every 12 months. Now, at first, this was an issue. There are many firms out there offering these services, and I've seen them priced anywhere from $2,000 to $10,000. So it's not hugely expensive, although every dollar in a startup, of course, is valuable. Investors will often want to see a 409A valuation to see that you're complying with rules, make sure they're not buying into potential tax liabilities of the company, etc. So be aware of 409A as you're thinking about your equity compensation. Consult with your advisors. If they don't mention it, they should. Just be aware that that exists, and the rules, like anything, could change. So don't assume that what I'm telling you today is going to be good tomorrow. Now, Rule 701 is important. So under the securities law, the federal securities laws, any offer or sale of securities has to be registered with the Securities and Exchange Commission, unless there's an exemption from registration. Registration is really like the whole process of going public. It's a big deal, costs a lot of money, requires audited financials, a whole bunch of stuff. Rule 701 exempts sales of securities made to compensate employees, consultants, and advisors. So just what we're talking about. And you can sell up to $1 million worth of securities under this exemption, regardless of size. You can sell more if you meet certain formulas and requirements. If you sell more than $10 million worth in a 12-month period, then other disclosure and financial things have to be provided. In any event, under Rule 701, to get it, you have to provide a copy of the relevant plan documents to all of the participants. So when you grant the option, you give them the paperwork, you give them all of this stuff, and you'll help secure your Rule 701 exemption. You can see when you say, well, how do I know it's $1 million or 10 million? This is where the 409A valuation meshes, even though that's under the Internal Revenue Code. So that's another reason for being able to support your exemption under Rule 701. There are no filing provisions for 701 federally at this time. State laws may require filings or impose other conditions, because in addition to the federal securities laws, we have so-called blue sky laws. Each state has its own securities laws. They're mostly uniform, but there are exceptions. California, for example, I think does require some filings. So just be aware that as you're going forward, that you shouldn't just say to the next employee, first employee coming in, I'm going to give you some options, and for 5,000 shares, and we're done. You have to put together think of all these things, put together a plan that's going to allow you to move forward and flexible, and make sure you're not tripping over all these things. So that is a quick overview of using stock and options as compensation. We've talked about the capital structure, so you see where common stock fits in that, in the returns, the splitting up of the company. We've talked about founder stock and some of the traps for Section 83 and how we might avoid them, and some ways to think about, how to talk about what percentage each founder should get. We've talked about ways in which you can provide equity as compensation, if that's part of the plans that you have and the culture you're putting together, and the various ways you could do that, and the pluses and minuses and requirements of those. As with anything like this, rules change. There may be another way of doing it enacted or tomorrow, or there may be restrictions imposed. So you're now well equipped to go and have an intelligent discussion with your advisors. So if you have any questions, feel free to email me, and otherwise go forth and prosper, as they say.